Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I have a fantastic guest on with me today who is doing some fantastic work in building awareness of the importance of incorporating macro data and events into investment management practices. This episode really could not have come at a better time, as macro data and events like Fed policy. Will the Fed raise, pause, or even cut rates? Inflation with oil prices spiking again. Inflation is climbing. Spiking government debt and uncertainty about the future health of the U.S. economy continue to be primary drivers of market moves. So with that backdrop, I think you all will enjoy today's guest and learn a lot, as I know I am. I'm very excited for this conversation, and I think you are too, and it should be a very engaging conversation. But first, today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. So I'd like to welcome Katherine Krantz. Katherine is the CEO of Trahan Macro Research and the CEO of the Center for the Macro Specialist Designation. Katherine has nearly 25 years of experience in financial services, including sell-side macro research, wealth management, and senior positions in operations. Katherine, thank you so much for coming on the show. It's a true honor to have you on. So can you start by telling us a little bit more about yourself that might not have been in that very brief bio, as well as Trahan Macro Research and the Center for the Macro Specialist Designation?
Sure, Ryan. Thank you so much for having me on today. It's a pleasure. Yeah, as you said, as my bio says, I've been in sell-side research. I've been a financial advisor myself, and now Francois Trahan and I started these companies about 3 years ago. We've both been in and out of the business for a number of years, and decided to go independent and really focus on this education side. I guess something that's interesting that wasn't in my bio is that for me, it was a choice between doing what I do or going to culinary school. So we know which way that went. But maybe in retirement, that'll be a goal for
There you
me.
go. Fantastic. Well, that's good. Culinary, that would always be fun too, especially for retirement, right? Maybe you can start a little side hustle
Exactly.
later on. So let's start at the top. Why do you believe financial advisors and wealth managers should focus on the macro when conducting investment research, and why should they care about what the Fed does or where interest rates are when trying to build an investment portfolio?
We believe that anybody who's in the investment business should be focused on macro. Our process is rooted in the business cycle, which is driven by interest rates, which in the US is driven by the Fed and monetary policy. So as the Fed changes their stance, that affects rates. And just obviously as a consumer, we see today, mortgage rates, almost 8%, right? That affects people's decisions about whether to buy or sell a home. That means they're going to hire or not hire a contractor. They'll buy furniture, they'll buy paint. All of these things go into consideration. And for those people that may not be getting those gigs or those jobs because the slowing is working its way through the economy, then they're not going out to eat, they're not going on vacation, they're not buying that extra purse, that extra dress. And so you can see how over time it takes time for these changes to feed through to the economy, but eventually they do end up impacting earnings and thus stocks. And so macro and fundamental analysis is really complementary. And we don't ignore fundamental data. Certainly earnings is something that is always on our radar screen. And because what we see is that when earnings growth starts to recede and slow and even go negative is really when we start to have recessionary fears.
Interesting. Part of GDP is the housing sector. It's a big portion. But what's interesting is it's not just the buying and the selling of homes, the transaction of a home. It's like you talked about, it's buying the furniture, it's remodeling, that goes into the GDP factor. So it's so much more than just that housing transaction, but all that you mentioned that goes into furnishing a home or remodeling a home has such a great impact on GDP and, like you said, jobs and the health of the economy.
That's
Um,
right. That's right.
Financial
And
advisors or analysts or allocators, you name it, really anyone in this industry, they have different methods to conduct investment research. And you mentioned one, fundamental analysis, right? You also can, people use technical analysis. And then, like we talked about, macro when conducting investment research. Why do you believe financial advisors or wealth managers should focus on the macro when conducting investment research versus looking at price trends or corporate earnings? You had mentioned just previously, you still look at corporate earnings. So it's not something that should be inclusive or exclusive. You got to pick one or the other. You can also do both.
absolutely, it's complementary. And while we don't focus on individual company earnings, we do look at things in aggregate, the small cap, mid cap, large cap indices. But, I know financial advisors come in many different flavors, depending on the model, whether you're independent or work for a big firm, wirehouse. And so I know different FAs have different roles. Some might be actually making investments decisions, some might be strictly client facing. But either way, even if you're strictly a client facing advisor, and I've like I said, been in that role before. I had my own RIA for a period of years. And when you go and talk to clients, they're not asking you about company fundamentals. They're asking you about macro questions, the big picture, right? They're asking you about, well, do you think, mortgage rates are going to come down? Because I really want to move, but right now it seems a little difficult, things like that. They want to know about the health of the economy. And so if you can talk to people in their own language, explain to them what's happening, why it's happening, and explain how Fed policy makes a difference, what those lags and the time for policy to take effect. That's really helpful to clients. And I know in the wealth management business, you really always want to be bullish, right? You don't want to tell your client that things are going to be bad, but I think the best thing you can do is tell somebody, it might be time to get a little bit more defensive. I was in that business, fortunately or unfortunately, during the financial crisis in '07, '08. And those were some really hard conversations. And, people would ask us, why am I going to pay you an advisory fee to have me in cash? And we would say, well, because you don't want to incentivize us to put you in something too risky just because it's in my interest. We need to explain to you why we think it's in your best interest to be a little bit more conservative right now. So I think those conversations are easier if you can really speak to it from a macro perspective.
It's such a great point. A few months ago, I was at a event, and there's a lot of financial advisors there and vendors, and they were talking about, just these conversations with clients, and it's all about, is it going to be a soft landing or a hard landing? What's the health of the economy? Oil prices, it's all centered. It's not questions about should we go in large growth or small value. It's all about things that really impact them, right?
Hmm.
And that's the macro. Am I going to have a job in 6 months because we're going to hit a recession? Or, like you said, moving, where are mortgage rates going to be? It's such a fantastic point that those are conversations that are being had and will need to be had. And so you got to understand what's happening on the macro side. So
Exactly.
now that we've talked about why is it important to incorporate macro data and events into investment research, what is the macro specialist designation?
So the Macro Specialist Designation is an education program to help people learn basically these techniques that I've been talking about. So Francois and I started talking about this about 7 or 8 years ago, and we all know that CFA is the primary designation a lot of people get. Certainly, the financial analyst world, the CFP as well. But Francois said, nobody's out there teaching macro. And I honestly didn't believe him at first. I said, oh, come on, there's so many designations. Somebody must be doing this. And so I went and looked and I came back and I said, geez, nobody's doing this. So we had a laugh and we said, let's create something. And what we discovered, Francois and I both have both undergraduate and master's degrees in economics. So, we say macro, and a lot of people think macroeconomics, but what we do is not about the academic track of economics. That's really theoretical. So what we're doing is like an applied version of that. And so we've taken, what we've learned in school and put it into an applied framework, but also what we've learned business cycle over business cycle throughout our careers. And really, the feedback that we've gotten from our current candidates is that the only other way to learn macro is to be beaten up by the cycle over and over again. And you learn those mistakes, right? But, this is a fairly young business. And, we just did a poll on LinkedIn asking people how many business cycles they'd seen. And more than half had only seen basically one business cycle. And so people, you do learn by your mistakes, but if it takes time. So the way we look at this is if you can learn those mistakes that could take decades to appreciate in a condensed format, you can really take your prime career years and move them forward, both in terms of
Mhm.
experience, knowledge, and absolutely an opportunity to make more money for both you and your clients. So we teach this framework of how to understand the business cycle and to know what to expect from the market going forward.
Interesting. You brought up the CFA. We talked last week or a couple of weeks ago, and when I was introduced to the macro specialist designation a few months ago, I was like, "Oh, that's really interesting. Maybe, I should look into it," because years and years ago, I took the CFA and failed level one miserably. And then I still have the books, and I look, I was like, "Should I do it again?" And I was like, that's not for me. I don't want to be an analyst. I don't want to be looking at, I just don't want to be, digging deep into financials and stuff like that. That's just, not where my
Mhm.
career is going to be heading. But a macro designation, sounds so much more intriguing. So it's refreshing that it's out there for
We've
sure.
had great feedback, and we look at it as not just an education program but a community. We're trying to build a macro community of people that can have conversations, share ideas, share content, and that's really our goal for this designation. It's both something that can advance your career, but it can also just make you a better investor and more knowledgeable about the framework.
Perfect. And that's exactly what I need, is to be more knowledgeable. So you had talked about too, just about history and the different business cycles. We often hear and talk about history doesn't repeat, but it rhymes, right? And as you go
Correct.
through more business cycles, you kind of, every business cycle is new, every different, every crisis is different. But, there are some themes that might overlap, which we can all learn
Absolutely.
from.
Yeah, we use that quote a lot, attributable to Mark Twain. Apparently, it does rhyme. Every cycle has its own unique characteristics, but we really do see a lot of the same trends, and we get the same questions, and we hear the same pushback cycle after cycle. And in the current cycle, what we're hearing a lot about is that people think that the lead or lag times associated with monetary policy changes in the economy is different this time, and that's always kind of a buzzword for us. It's different this time is when the alarm bells go off, right? Again, there are always nuances, but we don't think that there is a difference in the lead and lag times. And it takes about 18 months for changes in monetary policy or interest rates to feed through to leading indicators, of which the stock market is a leading indicator. It's one of the original components of the Conference Board's leading economic index. And we've just now reached the 18-month anniversary of the Fed's very first rate hike. And it's been the steepest, quickest tightening cycle that we've seen since the 1970s. So when people are saying that they think that the market's already priced in all the tightening, we say no, it's only just begun.
Interesting. It's 18 months ago. It seems like it was just yesterday that
It
they
does. I know
started,
it's
right? It's amazing that it's 18 months ago, but that's, and goes along with the Fed saying they need to be data dependent, and, and patient, right? As this, 50-year increase of interest rates and tightening trickles through to the economy.
absolutely.
What are some misconceptions of using macro data to come up with investment decisions?
Oh boy. So what I just mentioned, the lead and lag times is certainly something that gets debated. Uh, I think there's a lot of conversation right now about how AI is going to change
Mhm.
things, similar to what we saw back with the tech bubble, right?
Yeah.
Everything was going to be different. Companies didn't need earnings anymore. The internet was going to change the world, and it certainly did, but it didn't change business cycles for the most part. So, that's certainly a misconception. And I mean, AI is a game changer, and certainly will it eliminate certain jobs? Of course, but you can't say that it's going to change the structure of the economy fundamentally. I think other misconceptions are that if you have a really good company, that the macro backdrop doesn't matter. And I would just point back to the financial crisis, right? So if you had the best company, it might have been down a lot less than the market.
Mm.
But again, if you're a wealth manager and you have a client that cares about absolute returns, then that still matters. And so it's really a question of where do I see the risk appetite in the markets? And I think that's really important. So even if you hold really good companies, you still have to be aware of how much risk appetite is out there in the markets and protect your clients if that's not if it doesn't look good.
Interesting. You know, I go back to, and I thought it was just a crazy time, and a lot of it was driven by Fed policy. So on the macro side, but when during the pandemic, when money was free, and you had all those meme stocks and
Hmm.
AMC and GameStop and just going through the roof, and you had all these crazy market moves that there was no explanation really of what was going on other than a huge cohort of retail investors now having money to invest in
Hmm.
Reddit and social media. And now a lot of people during that time said fundamentals don't matter, macro doesn't matter, because now you've got retail investors and they're a big enough group of people, they drive markets. And I thought that was a misconception, because that free money that this retail it's because of Fed policy, right? And
Hmm.
all the government handouts and stuff like that. So let's apply what we have just talked about to today's investment backdrop. What is your and your team's outlook for the US economy and interest rates moving forward?
Well, unfortunately, the outlook from our point of view is not very good. As I said, we've just approached the 18-month anniversary of the very first rate hike. So we have a lot of tightening to still price in. You mentioned something in your intro about the level of debt. We've never gone into a slowdown with debt, with federal debt at these levels. That's very scary.
Mm.
Another thing that's abnormal is the amount of lending standards that have tightened in the economy so far because of the banking crisis that we had earlier this year. So we have an extraordinary amount of hurdles in front of us that, even without those, we'd still be staring at a significant slowdown given how much
Mm.
tightening we have in the pipeline. But given where credit conditions are at this stage and debt, it's worrisome because how much room is there for any kind of fiscal measures to be done in this situation? So we think it's going to be a slowdown ahead, and we're still seeing interest rates rising. So we typically see in a cycle equities bottom again 18 months after a peak in interest rates, and we're still testing those highs in rates. So it's a question mark as to when the slowdown could end, but we think it's going to be a bumpy road ahead.
Interesting, because for a while there, market consensus has really flipped over the past year. Everyone was saying, "Well, it's not gonna be a soft landing. We're gonna hit a recession. It's gonna be shallow recession." Then all of a sudden, it's kind of flipped, and the consensus was, "Okay, we're gonna see a soft landing." So it just adds to the uncertainty out there. And like you said, your main talking point is the lag. I'm not quite sure, we're at 18 months, but do people really know? Some people say it is priced in, others don't. I don't think it is completely priced in yet. And you're right, higher yields, they're still climbing. The inverted yield curve, still think should be something that people focus on. And to me, it's
Yeah.
crazy. 6 month T bills are or notes are 4.5, 5%.
Well, the yield curve has been a 100% accurate recession predictor. So, that's frightening. But, you raised an interesting point about a year ago, because one of the things we talk about in the Macro Specialist Designation program is behavioral finance and how the behavior of investors really impacts markets. And, a stock's price is made up of, other than dividends, basically earnings per share, and there's a multiple, a price to earnings ratio, and that multiple is driven by sentiment. And a year ago, what we saw, we were calling for a bear market rally, because when Chairman Powell was calling inflation transitory, which had been 18 months prior, we saw rates dip for about 4 to 5 months because people believed that. And so we saw that feed through into a little uptick in housing activity. And so we said, gosh,
Mhm.
I think this is going to feed through to markets. I think we're going to have a period where things rally. A year ago, we couldn't convince anybody that equities had a brighter future. And I was looking back at one of our research reports recently from about November, and it's kind of mind blowing to see that you're trying to convince people to be bullish. Now that sentiment is completely flipped, and in our view, the only thing that's changed, there's no fundamental data that's changed. And we still have the ISM, hovering below 50 for quite some time. The only thing that's changed is sentiment. So
Mhm.
that bullish attitude has really driven equities up. And so, as we know, that can turn quickly when things, and as we've seen, in recent weeks with some turbulence, and we've seen the U.S. dollar reaching, year-to-date highs, which is a signal that people are a little bit nervous.
Exactly. Great information. You mentioned transitory. If I had a beer here or something, it feels as if that should be, for a while, it was a drinking game. Every time we heard the word transitory, we were supposed to drink. It was like
Exactly.
all the time. So you mentioned your outlook, which is very interesting. I feel as if it's refreshing to get somebody that has data and information that supports their kind of bearish outlook on the economy. How does that impact investments, particularly stocks and bonds, moving forward?
Yeah, well, like I said, we think that the equity market's going to be in for a bit of a rough road ahead, and
Mhm.
so we, from a risk bearing point of view, we divide the cycle into three segments: risk on, risk off, and risk aversion. We consider risk off to be a time, basically, once leading indicators like the ISM manufacturing survey peaks and starts to fall. So we've been in that mode for quite some time. Now we think we're going to be entering risk aversion, where there is just no risk appetite. And that's when traditionally very defensive sectors do
Mhm.
better: healthcare, utilities, consumer staples, and anything that's highly cyclical is going to suffer. So, and from a capitalization point of view, large caps tend to do better than small caps. So,
Mhm.
anything that has more of a risk bearing cyclical profile is probably going to do worse in the coming environment. So, and again, the US dollar's been doing well, always a safe haven asset
Yeah.
when things go south.
Interesting. And the fixed income side, for years when interest rates were so low and fixed income prices were inflated, we had that, what is it, 40-year bull market for fixed income. Now, all of a sudden, over the past year or so, fixed income has really become very interesting asset class,
Hmm.
with yields now finally being attractive after, you know, people looking for income have been income starved for years and having to go, more on the risky side to find income. Is now still a good time, do you think, to get in the fixed income, or prices? You know, for me, I feel as if there's some total return opportunity. You got attractive yields, but though then if the economy does slow down, you could potentially get some price appreciation. Or is
Hmm.
there some other side to that story?
Yeah, I mean, we think treasuries are certainly a viable option, and like you said, in the meantime, the yields are at a point where you are making some income there, which is attractive for people. So yeah, that's certainly a place that could become a safe haven when things go south for equities.
Perfect. I've been thinking, we talked a lot about mortgage rates and yields. It's, you know, I think savers are being rewarded. They're really happy
Hmm.
right now with higher yields, but borrowers they're getting punished, right, with mortgage rates at 7.5%. So, if you're a saver, good for you. Congratulations. So,
Yeah.
yeah, go ahead, Catherine.
No, I was just going to say, and good for the people who, it's kind of crazy when you think how short a while ago that you had mortgage rates below 3%.
Yeah, crazy. It wasn't that long ago when they were, and it's like, gosh, will we ever see that again? What an opportunity. You kind of wonder, did people miss out on a huge opportunity to, capitalize on 3% mortgage rates?
Mhm.
Um, do you have any fun stories or experiences that you'd like to share? Usually I like to end the conversation on something fun. It could be professional, personal story, football related, and hockey
Oh,
since you're up in Montreal for the week.
yeah. Well, I won't talk about football because I'm an Aaron Rodgers fan, so
Oh,
I had high hopes for this year, but that's a little bit sad. But let's see, a fun story. I'd say one of my favorite stories is about 6 or 7 years ago. I was away with some friends on a girls' weekend, and one of my friends was the head of a sales division for a giant biotech firm, and she was going on their President's Club trip, and she was going to South Africa on a
ooh.
safari, and she happened to mention that her husband didn't want to go and she was able to take somebody else. And so I said, I'll go.
Yeah, you're waving your
And
hand. Me,
yeah.
take me.
And she said, oh gosh, I don't know if I can still, I told them, no, I'm not going to bring anybody. So anyway, long story short, 2 weeks later, I was on an all expenses paid trip to Cape Town and on safari in South Africa, which was one of the best events of my life, and got to go up in a hot air balloon over the prairie, and it was quite an experience. Very memorable.
I often well, it's true. I'm very sheltered. I haven't really been outside of North America. And it's interesting, I've had friends that have done the safari in South Africa. I guess I've never really thought about it, but now that you talk about it, and I've heard great things about it and how much fun it is, but I
Yeah,
may
it
have to
was
look into it.
quite a breathtaking experience.
All the different wildlife that you get to see,
Hmm.
and
And Cape Town's got a very beautiful,
really.
beautiful place. Hmm.
Well, I'll have to put that on my list of things that maybe someday I'll be able to do.
Absolutely.
All right. Well, thank you so much, Catherine, for coming on the show. It's been an honor. Where can our audience get more information about the Center for the Macro Specialist Designation and Trahan Macro Research?
So the Macro Specialist Designation.com, all one
Okay.
word, is for the designation. And we're also launching an executive education part of that, where we're going to be doing 2-day seminars in different cities around the world for people who want to just get a taste of it and maybe, either learn a little bit or test the waters for the full program.
Mhm.
And then TrahanMacroResearch.com is for institutional investors who want to subscribe to our weekly research reports. So the way we describe it is that if you want us, if we invite you over for dinner, we decide what to cook and you eat it, that's the research. If you want to learn how to cook, that's the macro specialist designation. We'll teach you the framework and you can interpret it in any way you see fit.
There is your potential
Yes,
culinary background coming into play right there. Perfect.
exactly.
And
Thanks, Ryan.
Trahan is spelled Trahan, correct?
That's correct. Yeah, Trahan Macro Research.
Awesome. Well, thank you so much, Catherine. It's been very enjoyable having this conversation. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Adjusted for Risk YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much and have a great rest of your week.